Hello and welcome to the Weekend Investing Daily Byte of 19th of July. And looks like the market is getting jittery. There is nervousness in the market ahead of the budget. Again, the rumors are doing their rounds. Maybe some taxation change will come around. People are thinking of getting out of stocks that have recently run up a lot. Maybe defense stocks, maybe public sector enterprise stocks. There was a bit of chaos everywhere today. But first, we are completing 3 glorious years of MI20 and MI35, two strategies that have given phenomenal returns in the last 3 years. And if you are willing to get on to these strategies, there is a offer code available till Sunday. AVR20 is what you can use. So the truth behind high quality stocks from a momentum perspective, I want you to understand this, but I'll talk about this more after the market commentary. But please first do subscribe to the channel, my request daily. There are a lot of folks that who are unsubscribed and who miss the daily updates. So market has done almost a bearish engulf of the huge move yesterday. This is despite Infosys coming out and ADRs going up 5 to 8% yesterday. So there was expectation that Nifty is going to fly today. That didn't come through, and we're down nearly about 1.09% on the Nifty. Nifty Junior also down 2.4%. So now we are down almost 4-5% from the top. We are nearing the 40-day moving average, and very soon probably there will be a bounce back, because going into the budget there will be positive expectations also, and we are now a couple of sessions away from that. Mid caps down 2.09%. Again, this breakout has failed. Now we have now come back into the same congestion zone here, and small caps also losing decent ground at 2.36%. When seen, however, in the context of the rise that we've had, still very small in terms of the fall. Bank Nifty surprisingly was very shallow sort of a range today within the yesterday's range. So Bank Nifty has not fallen at all versus others, 0.67% down only, and that seems to be the point of strength right now. Today's heat map mostly red. Infosys just managing a 1.9% gain. Other than that, you can see Coal India, ONGC, Wipro, Tata Motors, and TPC, Reliance, Mahindra, everything was beaten down 1 to 4%. Metals, especially Tata Steel 4.9%, JSW Steel 4%. A huge sort of a crack in metals and commodities space since versus yesterday. On other sort of Nifty next 50 stocks, also you can see huge amounts of red here. Stocks that were running very hard: Siemens, ABB, Motherson thrashed very hard, DLF thrashed very hard, PFC, REC down, HAL, BEL down. It is all across the board sort of price correction that is happening. Sectoral trends all red. Metals losing 4% in a day. Public sector enterprise stocks losing 3.2% in a day. Commodities 3%, energy 2%, autos 2.4%, real estate 2.4%. Only IT and FMCG to some extent were left unscathed. Pretty much move towards defensives, as I've been saying last couple of sessions, and everything else is on a profit taking basis. You have to see this profit taking in context. If something has gone up 100% in the last 1 year, there is going to be bound to be corrections at some point of time. We've not had any decent correction since I would think the year and a half that has gone by. So there is always a specter of a sharp correction at any point of time. That is the nature of the markets, and you have to live with that nature. uh, IT stocks, however, did not fall as much. Persistent, of course, did. Wipro did a bit, but overall, IT was down only 0.22%, and the IT chart is still looking very strong versus other sectors. In terms of stock spotlight, of course, the Infosys Q1 result came out post market yesterday, and a bit of that jump came in today with profits jumping 7%, but not so great. But I think people were expecting much lower than this, and it is now sort of forming a base here and waiting for a breakout. But at the same time, Nasdaq stocks are not doing so well, and IT stocks may have to wait for some time before the takeoff comes. So the truth behind high quality stocks is what we're going to try and understand today. I'm going to give you a lot of examples about how the perceived high quality stocks behave, and how our behavior can sometimes ruin our prospects with it. So, you may have heard this before, that 1 lakh rupee invested in Reliance in 1994 is worth 1.2 crores, 120x gain, 17% CAGR. But how was this journey? It is very easy to say you could have invested X there and you would have 100x here. You could have invested Y there and you'll have 50x here. But ask somebody who has actually lived that journey, and you will realize that it was never a simple task. For instance, nobody would have told you that 1 lakh rupee invested in Reliance in January 2008 would be worth the same 1 lakh rupees by March 2017. So you had 9 years or maybe 10 years of no gain in Reliance, and you had to sit through 64% kind of a fall during this period. This journey is not easy for anybody to make. Again, if you see from a longer perspective, you had a fantastic run from 99 till 2008, and then you went into this 10-year limbo, and then from there, of course, you've had another 4x or 5x return. But to live through this 10 years is the key, and to live through these 10 years and then to manage to hold on for this till this point. It could also happen that you lived through this for 10 years and it came down like this. So after 15 years, you may realize that, my 15 years is wasted and nothing has come out of it. So the truth behind quality buy and hold trap is that you cannot just depend upon quality, because you don't know how much of the future has already been discounted. For instance, Hindustan Levers went up dramatically from 25 rupees to nearly 100 rupees, 120 rupees from 96 to 2000. But then it took a sweet 10 years to break out of that band and then go, from 120 to 2200 after that. If you bought here, maybe you could not sustain these 10 years. Maybe you just sold off immediately on after 10 years. Even if you got a rupee of profit, you said, let me get out of the stock, because it is easy to, in hindsight, to see, as they say, in your rear view mirror, hindsight is always 2020. But if you are going through this journey, you don't know where it is. So like right now, we are in sort of a range on this HUL stock. Maybe this will become 5 years, 6 years, 7 years, 8 years. You don't know. And even after that, you don't know whether it will go up or not. Wipro went up dramatically from roughly 1 rupee to 275 rupees. Can you imagine that? That in 2 years, a stock went from 1 rupee to 275 rupees. And then it broke that top only after 21 years. So if somebody bought here in year 2000, first of all, they got a 90% drawdown. So 1 lakh became 10,000 first, and then over 20 years, it recovered back to 1 lakh, and then also it has only doubled since the last 5 years. So from here to here, the journey is not good. Not good at all, and very difficult to hold it. Asian Paints, another superb, very high quality stock, has been going up dramatically, but since 2021, stuck in a range. Already 3 years gone by, maybe next 3 years it may do the same, or it may fall, or it may go up. Nobody knows. But so you are buying time, when you're doing this. Eicher Motors went up from to 300 rupees to 3000 rupees in motor 4 5 years, and then it took a sweet 5 6 7 8 years to really come out of this base, and it is just marginally up since then also. So after the run up has happened, you can't really say how much of the future has been discounted, and this point is likely the point where most people will get stuck, because when everybody is shouting from the rooftop, buy iShare, buy Reliance, buy ITC, that is where things go wrong. And ITC, for instance, 2002 till 2016, dream run of the stock, but 2016 onwards, it took almost 5 6 years for it to really break out from there and go higher. And it is not necessary that all of these stocks will break out even after 10 years, because technology is changing, market share is changing, management is changing, there is new preference for consumers what they want to buy. Things can change over 10 years. So if you block your capital for 10 years hoping for a pop after 10 years, and let's say some structural changes are happening, then you are basically wasted your capital. So my sort of approach to this is that buy and hold suits very well for those folks who have enormous patience and who have vision for 20 years. And I can tell you, very few people of those kind are left in the market today. It's just human nature. We are all attracted towards shorter gratification. We don't want our journeys to be bad. Even if I say buy and hold gets you 25% CAGR, but if a much smoother, much easier journey gets me 20% and I sleep well, I'll probably choose that. I don't want 25%. Right. So if you go with a strategy where you are taking out losers periodically, you are staying with the winners, at least at all points, you are feeling good about your portfolio. Why should you feel so, cringed up about your portfolio that, oh, I put all my money into these stocks and they're not moving and everybody else seems to be enjoying. Why should I go through those emotions? So this is a sort of a personal choice. Of course, one size does not fit all, but we've seen a large number of people, especially in momentum investing, how they've loved their journey going forward, how automatically the performing sectors come into your strategies, how you are not subject to stocks that are hitting 50, 60, 70, 80% drawdowns, and then you're hoping and praying that let my stock go up, please. That situation doesn't arise. You just cut your losses and you ride your winners. That is the way to go. So let me know your thoughts on this. It'll be great to have various different opinions on this matter. Thank you so much for watching. But last but not the least, my request again, please like and share these videos and subscribe to the channel. Thank you. Bye.